Ladies and gentlemen, good day and welcome to the Q3 FY23 earnings conference call of Cholamandalam Financial Holdings hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sanket Chheda from DAM Capital Advisors. Thank you and over to you.
Thank you. A very good morning to all of you. We have with us the entire management team of Cholamandalam Financial Holdings to discuss their Q3 results. So we are accompanied by Sridharan Rangarajan, who is a director, Mr. N. Ganesh, who is the CFO, Mr. Surya Narayan, who is MD Chola General Insurance, and we have Venugopal, who is the CFO Chola MS General Insurance. So without further delay, I would hand over the call to the management for their opening remarks, followed by a question and answer. So over to you, sir.
Yeah. Good morning to all of you. This is Sridhar. I have with me my colleagues Surya Narayanan, MD, and Mr. Venugopal, CFO of Chola General Insurance, and Ganesh, our CFO of the company. The consolidated results of the company consist of Cholamandalam Investment Company Limited, Cholamandalam MS General Insurance Limited as subsidiaries, and Chola MS Risk Services Limited as a JV. The total income for the quarter ended December 22 increased by 28% to 4,777 crores, while profit after tax increased by 33% to 720 crores. Cholamandalam Investment and Finance Company, you might have heard the call, and the entire details on the presentation and the transcripts are well available. Chola has delivered the best ever dispersal, collection and profitability in Q3 FY23. Chola has gained market share across product segment in vehicle finance and other business units. AUM as of December 31st, 2022 stood at about 1,03,189 crores. This is a milestone. The company holds strong liquidity position. ROE is at 19.1%, and the CAR as of December 31st, 2022 was at 17.75%. Cholamandalam MS General Insurance Company registered a written premium of 1,625 crores in Q3 FY23, an increase of 23% over the previous year, driven by growth across channels and partners. The company continues to have dominant presence in motor segment and is strategically diversifying across motor ecosystem. In Q3, the industry grew by 18.5%, which sector players by 22.3%. YTD December 2022, industry grew by 16.2%, and private sector players grew by 21.6%. For the same period, Chola MS delivered a growth of 27.5%. In motor, Chola MS improved the market share from 4.9% to 5.3%. In PA, it grew the market share to 4.9%, and fire business, the growth is at about 37%. YTD December, motor, representing 69.3% of the portfolio, grew by 24.5%. Commercial, representing 14.3% of the portfolio, grew by 37%. Health, accident, travel, and personal accident, representing 16.4% of the portfolio, grew by 38%. Within motor, two-wheeler and passenger car share 21% and 36% respectively. Commercial vehicles at 44%. The company's long-term policies growth was and priority reduction. The company continues to upfront absorb the full cost all long-term policies. However, the UPR get earned over the long-term policies creating an embedded value in the balance sheet. solvency ratio as of December end is at 2.06 compared to the same period last year, which was at about 1.86. Profit after tax for Q3 FY23 was rupees 43 crores against 18 crores of last year. YTD PAT was at 116 crores as against 62 crores in the same period last year. With these comments, I would like to now open up for question and answer. Thank you once again.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Devansh Negotia from Simple. Please go ahead.
Yeah, sir. Thanks for the opportunity. Just a couple of questions. So one is in case of in case of our motor book, since we have significantly built the two-wheeler and PV book, and that has come at a very high cost. So where do we see this mix settling in terms of our targeted mix between PV, two-wheeler, and commercial vehicle? Any thoughts if you can share?
Good morning. Presently, the two-wheeler mix is at about 21, 22 or so, and the passenger cars is at about 35 or so. Over the medium term, with the buoyancy in commercial vehicles emanating, we would expect to see commercial vehicles at roughly at about 50% of the book and balance between two-wheelers and cars. We've also seen the regulator coming up with a draft exposure on long-term relating to tractors. If that were also were to come through, then we could see a growth even in the tractor segment as well. But broadly, 50% commercial vehicles and non-commercial vehicles at 50 is the mix that we see going forward.
Okay, so the mix will remain broadly. So we have achieved the targeted mix that we were looking for a long period of time, and we have achieved that now.
I think given our channel presence, which is well diversified across, and the financial tie-ups, including the sister company relationship, we would expect the mix to settle at around this level.
Okay. And how do you see the competitive intensity in motor insurance, both in OD as well as two-wheeler? And if vehicle-wise, you can share your commentary, how is the intensity right now?
See, the competitive intensity is at its peak across categories. It is not that it is in any way greater or lower in any particular product segment. Quite naturally, the peak competition would be in the cars and two-wheelers, especially in the new vehicle space, in the OEM segments. It would be relatively lower in the commercial vehicle space. And the key is having long-standing relationships with financial partners. So thankfully, Chola MS has these partnerships in place, which should help us.
Okay. Okay. Because so we find the competitive intensity high in PV and two-wheeler, and that is the book that we have built in last 2 years. So just little confused on the targeted combined ratio that we want to achieve. And also how we're thinking in terms of risk reward and pricing in different vehicle segments. So can you just share your thought process?
The competitive intensity with respect to pricing discounts has meant that the wound damage LRs have remained at an elevated level for almost all players. You could possibly have heard it in other investor calls as well. But then Chola MS has been, by virtue of its mix and granular choice, has been able to keep the motor OD loss ratios fairly. For instance, in Q3, we are at about 68,
Yeah.
So where we have been able to reduce it from Q2 level and from Q1 as well. So I think this is more or less at the level. Maybe another 1% improvement can possibly come through. But then that is where we expect this to settle for the time being, unless the discount situation improves. So that is what we would want to think as far as the ODLRs are concerned. As I've always maintained in the past, the motor third-party LRs would also depend on the kind of price increase that the government is considering for the ensuing year from April. It would largely depend on that. That is what would make the overall motor portfolio as such in totality. That is where the COR would rest. But then let us also understand that it is the motor portfolio which brings in the investment book, which companies use for building the corpus as well as generating the investment income.
Okay. And how do we see the competitive intensity in terms of remunerating the distribution channel? Because we have seen OPEX being across all the players. So is it easing, or is it still at peak, or can you share some direction on where is it heading?
There, see, the competitivity is there, and it's a function of choice as to where we want to grow and how much we want to grow. It is always there. We have already seen some larger players tone down growth in the motor segment, and in fact, even if we look at our growth is in motor is more or less on the same level as that of the industry. So we are just about maintaining market share, so to speak. If private sector has grown at 20.8, we are at 24.5. So that is the level that we have seen our growth. And our reported growth, let's also consider that it takes in the long-term premium which has turned into premium from previous year. So that element is also there. That addition is also coming in. So coming back to your question on market sourcing costs, the market aggression is there, but then we would have to manage our cost to stay only with our choices as to line of business that we want to be in, and also the geographies that we want to operate.
Okay. That's it from side. I'll just come back in the.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Sanket Godha from Avendus Spark. Please go ahead.
Thank you for the opportunity. Sir, we mentioned that last quarter we took some corrective measures with respect to health and PA to improve our loss ratio. But if you look at the third quarter number, it still remains little on the higher side, around 71%, a marginal improvement compared to what we have done it in second quarter. So just wondering whether it comes with a lag, or is it because the claim severity seems to be higher, or pricing competition led to that higher loss ratio? That's my first question.
Yeah. So on the health alerts, we have made some corrections with respect to pricing, both in our retail products as well as the products that we offer to our public sector bank tie-ups. So there is a price correction of about anywhere between 20 to 25%, which has been done. and we do expect that the benefit of such price increase will start reflecting in the LRs as we go along.
Okay. So it's more to be get reflected in the next year rather than getting reflected in the current year, because as this will run off, then only you'll see the benefit, right? That's the way I should understand, sir?
Yeah, the larger effect would be seen, but we should start seeing the trend even for Q4 when we get there.
Okay, sir. Got it. And second question is the basic expense of management, because in the new regime of expense of management which is proposed by the IRDA, it says that you can't breach 30 or the number for multi-line players is 30, and today we are at 40. So any what you call a path you want to guide us to how you will ultimately achieve 30, whether we will increase our exposure to wholesale businesses. Currently we are 84-85% retail in nature, which is OPEX intensive. So any thoughts, if you can share, how we gradually will move in that direction without deteriorating our combined?
Yeah. So there are 2-3 dimensions to this question. First is that the present method of computation, that 40, also includes the long-term premium that we are collecting, especially in motor, which is not reflected in the top line.
Right.
So as an industry, we have represented to the regulator that while for evaluating and computing this limit, we should see this in total. So that is the one element. The second element is that the company may consider an entry into the crop insurance business, which can help in toning down and providing the balance for the ensuing year. So that is a thing that the board has discussed, and probably we should have greater clarity as we freeze our business plan sometime later next month. That is the second dimension. The third dimension is that anyway the regulator is also giving a glided path for reduction over a 3-year period. So it is not that the reduction is expected overnight. So that is also a choice. And as I have said before, as we attain scale, some economies of scale would start kicking in terms of our own operating expenses, which we are also seeing presently, even the present scale up, resulting from the 27% growth is giving us some say. If we look at it, our expense structure is lower than what it was in Q1.
Right.
So from Q1 to Q2, we had a 3% drop, and from Q2 to Q3, we have had a 1.9% drop. So this benefit should start also helping. But to answer your question, whether all these will take us to 30 overnight next year, the answer is probably no. But we would well be on the glide path towards converging to the stipulated number over a 3-year time frame.
Okay. So basically, is it safe to assume that maybe somewhere around 26 or 27, FY26 or 27, you will ultimately achieve closer to 30 kind of a figure in the OPEX ratio?
Yeah, that would also be a regulatory requirement. The window is 3 years.
Yeah,
so
got it, sir.
We need to have our plans drawn up to converge to that by that time frame.
And when you said crop, sir, just wanted to understand that in crop you intend to have it very closer to your overall market share of the company, your exposure, or you are okay to go little overboard. And also want to understand that in crop, given you are re-looking into it, it will be more into that 80-110 formula only where you will do, or you are okay to do in the normal way of doing crop also?
These are one as a proportion to our total top line. We would like the crop insurance to be somewhere in the 10 to 12% range. Is what we would like to have, not to be excessively dependent on that line. Would be the broad guideline. That is A. And number two, we will also have to clearly look at the guidelines, the crop insurance guidelines that the government is expected to come up with.
Right.
Relating to the various methods that are there. Today we do have the loss corridor options that are available. And there are pros and cons of doing the loss corridor method as well as the conventional PMSBY, which will have to be evaluated.
Okay, fair, sir. And the another question which I had was basically when I see your one of the slides where you mentioned that your market share in the new two-wheeler is 8%, which I believe at the start of the year, that is in 1Q FY23, was 10%. So it has come off a bit. So anything to read there, sir? Is it a conscious decision where you have lowered your market share because of the intense competition, or in general it has become a crowded space and that's why you saw a reduction in the market share? And if I want to connect it with the Chola Insurance Express officers, which have come down from last year of around 500 officers to 350 kind of an officers, has that also played a role? Just a broader picture, if you can, or both are unrelated. Basically, if you can tell me on those lines, will be helpful, sir.
This is the market share in two-wheelers is a function of the competitive intensity and the economic viability given the pricing and the discounts. So we have pruned our presence in some geographies and in some product categories, make models, to taking a granular look at the loss experience and the related sourcing costs.
Yeah.
So that is what is come about there. And some of the it's a two-way movement when you look at even our location and presence. While we have stepped in and got into newer locations, some locations which probably haven't really grown or haven't lived up to the potential. So we have also taken a call to reduce our presence in some of these locations. So that is I believe, a constant evaluation of market-related opportunities that exist, which is what the teams have been doing.
So that is predominantly the reason why your motor OD loss ratios have come down to 68, meaning that calculation, that recalibration of the...
It is a function of that as well, very clearly, because we have made our choices and those choices seem to be working in terms of managing the overall loss ratios. And these are not one-quarter choices. These are continuous choices that we make, because any choice that we make lives with us and casts its shadow for at least 1 year. And in case of long term, it will have its shadow for 3-4 years. So these are continuous choices that the teams make.
Got it, sir. And maybe finally, if I can ask a data keeping question, how much of our total premium is now from long term in our GWP in the current 9 months or third quarter of FY23? And finally, one more one.
I need to answer that.
So the position as of December 22, we are carrying 1,381 crores of the premium, which belongs to the.
What is the percentage of the premium in the book? It's about 8 point. Roughly about 8.8%.
No, actually, the embedded as at 9 months is at about 9.8%.
9.8%, right, sir?
9.8.
Okay.
More or less, even Q3 it was at about 9.7. So it's more or less settled at now at about 9.7, 9.8%.
Got it. Perfect, sir. Yeah, that's it from my side. These were the questions. Thank you.
Thank you. Ladies Ladies and gentlemen, to ask a question, please press star and one on your phone. We have our next question from the line of Yash Mehta from Steinberg Asset Management. Please go ahead.
Hi. Thanks for the opportunity. One question on what was reported last year. So if I look at your March presentation in 22, there were two one-offs, 200 crores of COVID claims and 263 crores of IRDA order impact on write-off of deferred acquisition cost balance. That 463 crores ideally shouldn't have continued in the current year. So one would have expected that about 100 odd crores per quarter would be added to the bottom line of the company from last year to this year. But the actual translation has been closer to 20% of that in terms of improvement in what our absolute numbers are. How do you reconcile the one-offs and look at the steady state profitability? Because even today, our ROE is not reflecting the old ROE levels, pre-COVID ROE levels.
Yeah, to answer the question on the 463 crores which you have talked about as a part of health COVID claims and the prepaid expenses which you have written off in the last year, 21-22. See, there are things which are happen as a part of the motor third-party claims. Okay, there are benefits that were flowing the last year in the form of the lockdown benefit and other things is also not there. When there are costs associated, one-time cost, there is a one-time benefit also flowed in the last year. That was not there. And you know very well that the motor third party, there is an inflation. The premium increase is not much in the other than the long-term part of it. So with that, the inflation element itself is costing us more. This one portion as a part of that as a reduction. Second part is also that the growth is around 28%. The long-term share, we have already said that around 9 to 10% on the mix is also there. Coupled with that, there is no prepaid concept that has been followed in 22-23. The entire absorption is taking into the P&L part. So I'm not putting the numbers here. There are positives and negatives there in the earlier part. There is an element of continued level of the growth is absorbing the cost also is part of the dip in that. This will create an embedded value there as a part of which the earnings will come into the next year without cost.
Do you see, let's say, improvement in our ROE from here on? Because the way it seems we are increasing the share of crop business, and that's probably not as profitable as the overall business today. And on top of that, we are kind of adding, let's say, the long-term policies continue. So just want to understand if our ROE will see pick up and where do you see it stabilizing?
Definitely the ROE will pick up because the growth in 22-23 is around 28%. We are more than the industry from the point of view of. That's why the earnings will take time. Coupled with the long term, it will take long time for us to take the profitability. So ROE will improve in the next period onwards. But we have already improved in terms of you already said that 20% of the thing only improvement is there. That is only because of the point on the growth and the long term point of view. And also on the TP front, the inflation is there. So coming years, definitely you will see that the ROE to improve because already every growth-based acquisition cost is absorbed in the current year.
Understood. And what we've seen is your partners like IndusInd Bank and Chola, their disbursements on vehicle finance have been absolutely stunning for the last quarter or odd. But when we look at that translating into our growth from these channels, it's not really coming through that well. So are there nuances which I'm missing here in terms of why our growth from these channels is not reflecting the growth that they have seen in their books? Because they've started lending to acquire these vehicles. So ideally one should see them selling insurance on this vehicle.
Yeah, your observation is partially right to the extent that in the case of new vehicles, the control over the insurance is with the dealers, whether it is cars or two-wheelers or OEMs. The financiers' control over that would be definitely lower. So the financiers' control always comes in only in the case of medium to term in used vehicles, certainly, and in case of new vehicles in the later years. So to that extent, it will not reflect directly, because that business is anyway it's market related, which is controlled by the OEM and the dealerships. So it will not reflect it. The immediate increase in disbursements is not going to reflect directly in an insurance premium.
Understood. And given let's say the implications of the expense on management regulation that the regulator has now come up with, we've consistently for the last 2 years have had money from shareholders' account getting transferred to the revenue account. How do you see the implications of this on us? Because this is relevant to us because we are above the 30% mark, which is how do you see it? Is it a positive? Is it a negative? How do you approach this regulation, and will it benefit you gain cross-subsidize better? I'm just trying to understand from a strategic perspective.
See, from a pure strategic perspective, it only clears up the compliance-related aspects greatly. From a market perspective, the sourcing cost is not really going to reduce. The intermediary ask is not really going to reduce. So it's more a question of how nimble players are in choosing the geographies profitable and yet are able to manage both the loss ratios and the cost. So the game is all about managing your overall combined ratio and not really to look at any element in isolation. So we cannot say that you may have a higher cost, but if your loss ratios are okay, then it justifies it. So the economic view is what players would start taking, which is what they have been taking as well. And that is how business would be run. In that sense, the EOM, the freeing up the EOM and the flexibility being given to insurers and insurer boards is a welcome step.
Understood. Fair enough. I'll come back for other questions. Thank you.
Thank you. We have a next question from the line of Devansh Nigotia from Simple. Please go ahead.
Yeah. So thanks for the follow-up. So in case of health insurance, what you are seeing is that everyone is going for 20-25% price increases. So can you just help us, can you give a perspective on how is everyone in the, all the players, how they are taking price increases? Can you just throw some light on that? And we have taken 20-25% price increase.
Not clear, Devansh. Could you please speak?
Can you use
the mic or yeah?
Am I audible?
Yeah. Can you repeat the question?
Yeah. So we just mentioned that we have taken 20-25% price increases, and we've in health insurance, and similar commentary has been there from one of the listed players as well. So can you help us understand how is the regulator's response to this price increase, and how also other players in the industry are responding to this type of price increase? Is everyone taking 20-25% price increase, or is it only few players?
Yeah, players have stepped up prices. The PSU players have done, the SAHIs have done. Even large private sector players have effected price increase, which is also inevitable given the medical inflation that is prevalent. The regulators' own publication is suggestive of a 12-14% medical inflation. So advanced age, especially, see, it also happens when in renewals, when people are renewing and they are in their 8th or 9th or 10th year, it linked to age linked, the pricing also goes up. So it is inevitable that prices go up in the health sector. So it is there, and customers are paying the price, if not to Chola MS, also to other companies.
Okay. But this 20-25% price increase is beyond the price increase that happens on change in cohorts, age brackets. Is that the right understanding?
So it is across. For example, see, health insurance caters to multiple needs. It meets accidental hospitalization, so which is not really age related. It is also meet children ailments, which again has nothing to do. But inflation is across. Whether it is the incidence of an ailment is probably the higher. The probability is higher in an advanced stage. But then other hospitalization needs also suffer this medical inflation.
Okay, got it. And how has the claim experience been with the motor TP 6 months regulation that had come in place? How are we seeing the settlements happening on the ground with the courts now?
It is more than courts. Actually, we have a Madras High Court which is endorsed the law, which has come in from April 1. So we would need to see as to how other high courts also appreciate and endorse this particular amendment. For the moment, what we are seeing is some improvement in faster reporting of claims is something that we are seeing on ground. But we will have to still wait and see as to how the other leading courts in the country take a view on this. And that would be critical to the way the ultimate loss ratios shape up there. The law is clear. Now it is up to the courts as to how they implement the law.
So by that we mean that only Tamil Nadu is following the 6-month intimation and it's not being followed by all the states?
See, Tamil Nadu has come up with a judgment upholding the 6-month time limitation very clearly. So similar upholding will have to come in other states. And then, yes, that there could always be appeals that could lie to the Supreme Court. So ultimately, we believe that this matter will get settled by the Supreme Court sooner than later.
Okay. I'm actually still confused because I'm just trying to understand how, so let's say the settlements which are happening after 6 months across India, can you help us understand how is the claim experience? Not only in Tamil Nadu, but even in other states. Are there rejection of claims because they have exceeded the 6-month limit or?
No, let me explain this. The time limit is only for intimation of the claim. Settlements, court proceedings can take longer. So there is no time limit as to the settlement itself. If the tribunal and court wants to hear that particular case only after 2 years, there is nothing that anyone can do. That is purely the way things progress in the court. The time limit for limitation only brings in a higher level of certainty as to the liability, as to how many claims are actually reported. Then it's a function of the prevalent severity for that nature of accident, or whether it's a death or an injury, and the earning potential of the individual concerned who has suffered it. So that would determine the ultimate part. So this only brings in a finality and a certainty as to the number of claims that an insurer would have to pay for ultimately. The timing of payment, if a company is more negotiated settlement favoring position, takes that position, it will happen faster. And if an insurer waits for the court decision, then it will take longer.
Okay. So, okay. So I mean, I'm just trying to understand that have there been any rejection of claims which have exceeded 6 months time limit? Because now we are in, I think, Feb, so it's already by October there should be 5 months where we have seen such cases, right? I'm not sure if you're able to understand my question or.
No, it is, in Tamil Nadu, as Madras High Court has clearly given a verdict for both prior to 1/4/22 as well as accident from 1/4/22. So these are all strictly followed by the MSCs. And our thing is also, we are also, seeing it closely from the point of view of each of the MSCTs in Tamil Nadu. We are also looking at the other states also as to strictly implement the, new motor vehicles rules. But having said that, it is too early at this stage to, come out with a clear level of how this happens or how the MSCTs are going to take it up and how the high courts are going to take it up. But we are monitoring each of the MSCT cases very closely in terms of that. We will definitely appeal those cases wherever it is being admitted by MSCT if at all. So that's the process internally we have. We will be implementing it very strictly.
So for it to be implemented pan-India, it will still take time. It is only the Madras court that has come up with this ruling.
No, it is the Madras High Court stage they have clarified. In the MSCTs, many of the other states are also following the 6 months limitation. Wherever the 6 months is not adhered to by the MSCTs, we will appeal against that.
Got it. Oh. And if you can also elaborate on the strategy X motor on fire insurance, personal accident and health insurance, what is our strategy going forward? What is the target focus? What are the kind of policies you are looking to launch? And if you could just share some soft points.
I think the fire insurance, so we are been growing in that space as was mentioned earlier. So we've grown well in the 9 months to date. Thanks to our bank assurance partnerships and the general credit growth that is happening in the banks. These have been large drivers. We also have some headwinds that have been announced or are more likely to come up. We could potentially see some price contraction in the fire insurance space. So that is possibly there. And also with the kind of losses that global reinsurers have taken, so the reinsurance costs can go up. So that is what both even GIC Re as well as other reinsurers have sort of indicated. So this will have to be priced in by all insurers when they offer their products to the customers. But nevertheless, it's a segment that will keep growing and we would want to grow there. Also as a part of our strategy to increase our proportion of non-motor business. So that is on the fire segment. The personal accident is something which goes well with our bundled products along with our other motor and dwelling and other related insurances that we sell. We have maintained a good pace and growth this year, and we definitely hope to keep that going and then operate at somewhere at a 5% market share, which we have presently. So that will also grow as we see.
Got it. And in case of health insurance?
Health again, see we have been growing faster in the attachment and bundled space, as also the volume that we get on indemnity from banking segments. The agency segment, in fact, in doing the last quarter, we had our new product launch, which is called the Flexi Supreme, which is doing well in the market, and we do expect the growth to come in. As I've said before, ideally we would want our the indemnity benefit mix to be at about 50-50. Today it is actually loaded more in favor of benefit. So that the mix readjustment will come by a faster growth in the indemnity over the benefit products. That's the intent, at least to balance it at 50-50.
And how would you comment on competition in health insurance as of now? Is the competition easing up or the competitive intensity is high, or can you elaborate on the direction of competition?
See, in general insurance, in every line there is competition. So it is not that any particular line has less competition, and in health it is more. You have 5 more Sahis who are competing in that space and who are probably focusing on that as the only line of business. So I would tend to think that the intensity is no different in the health line of business as compared to motor or as compared to fire. So it's again a question of the appetite for that business. And naturally, as general insurance players, we have other avenues which have their relative advantages. A motor has a certain advantage, a fire business has a certain advantage, and so does health. So the relative choices always come.
Okay. So just last question. We mentioned that the new investment book that you are building, we're building it at 7.2, 7.4, and 7.6% interest rate. So what is the expected investment yield that we are expecting in FY24 and FY25?
Yeah, see, the interest rates are going up. That's the part which the incremental investments are being deployed at the high yields. That's why we are talking about the 1.6% deployment. Still, the older books are carrying at a lower yield. That's why we are expecting around 7% yield by end of March 24. March 25 is again, we need to think about what would be the interest outlook and inflation and other aspects. So it will be more than that, basically because the older investments will be invested in the high yield. So exactly cannot be quantified. It will be more than 7% for 25.
Okay, so that's it from my side. Thanks a lot.
Thank you. We have our next question from the line of Parag Thakkar from Anvil Wealth. Please go ahead.
Yeah, sir. Thanks a lot for taking my question. I think my question is not on insurance business. My question is on Chola Financial Holdings valuation. When we are discussing so much about...
I'm sorry, your voice is breaking, Mr. Thakkar.
Hello?
Yes, can you repeat your question, please?
Yeah. My question is more on Chola Financial.
I'm sorry, you're sounding muffled.
Hello? Now it is okay?
Please go ahead.
The question to entire Chola Financial Holding team is that while you are building the business of insurance, taking so much of pain, the valuation of Chola Financial Holding does not even reflect a single percentage out of your Chola MS insurance business value. Because if you see 46% stake in Chola Investment and Finance, that itself is worth 29,000 crores, while your current market cap is only 11,650 crores. So you are already getting a huge discount to your holding in Chola Investment and Finance share. And I don't know, for 50 minutes we are discussing only MS General Insurance business, where you are, after taking so much of pain, you have built up that business. But actually, for a shareholder, this business is available for free. So my question is, what we are thinking to unlock this value, whether any buyback or promoter trying to increase stake, what is to be done to unlock this value? Because see, Bajaj Holding, Maharashtra Scooters, various other holding company stocks are there where the value has unlocked. Because for example, I can give you in Bajaj Holding, the promoters themselves kept increasing their stake. And so the value, finally market realized some value. And now it trades at 40% discount to its value in Bajaj Group shares. While you are trading at 1/3 of your investment only in Chola Finance. And this Chola MS General Insurance, whatever 200 crore PAT or whatever you are going to make, is absolutely available for free. And there you have 60% stake. So my question is, what we are thinking as a company to unlock this value?
Yeah, thank you, Mr. Parag, for asking this question. So our job is to explain to the investor community, and I think I just want to take this call as probably the concluding question also is, see, we have come a long way in building this fine insurance portfolio, There were some challenges in the last couple of years. We have all overcome that. Business is done very well. The growth has come back. We used to grow at CAGR of 20% plus, except the last couple of years back. We are back into that growth trajectory. We feel that the investment book size that what we have built, we can work on improving the yield, which I think we will do this in the coming years, which will definitely augur well in terms of the profitability of this portfolio that what we are building. Insurance as an industry has got a long-term potential, and I think we feel that that will also augur well for this portfolio. And I think the loss ratios currently what we are seeing is coming down. I think the work that the team is doing in terms of the portfolio change that they are doing, both in terms of the product as well as in terms of the geography that they are doing, will also help to bring the loss ratios coming down. So in a play where the growth is there, combined with the loss ratios coming down and the investment yield going up, and with the embedded value what we have created in the balance sheet for the long-term business that we have got, I think the profitability will go up in the next couple of years. You will start seeing this franchise building such a good return to the investors. I would leave at this stage, beyond which commenting on that would not be appropriate in this call.
No, I think, yeah, correct. I absolutely agree.
I feel that this is a choice that the investors should make. And I think we have, as you rightly said, that probably the investor would realize, an investor like you would probably have absorbed it right. And I think it will start percolating down, and more people will start buying the shares. And our job is to deliver the performance, and that's fair.
No, that I appreciate, sir. That I appreciate. But the only point is, Chola Finance is doing so well. This quarter result was absolutely phenomenal. And so Chola Finance right now, for example, so I don't know how investors miss this, that if you are buying Chola Holding, you are getting Chola Finance at 10 P. But Chola Finance and the underlying entity is doing so well. But the point is that it was just my point that in order to unlock value, there is something which management also has to think on that line. You see, you very rightly, and I really appreciate that you commented about the future growth prospects of Chola MS. But my point is that Chola MS is not getting any value only as of now.
Mr. Parag, I think your points are well taken. As I said that the investors should take a calculated position both in terms of the performance of the Chola Finance as well as Chola General Insurance. Since it is a holding company, obviously they would look at both, and our job is to present these portfolio choices that we have. And as you rightly said that the performance of the NBFC is done superbly well. Insurance has also done well, and I think my positive feeling is that investor community will start appreciating that going forward.
Thank you. Participants are requested to restrict their question to one at a time. We have our next question from the line of Prateek Poddar from Nippon India Mutual Fund. Please go ahead.
Yeah, hi. In parts and bits, this question has been answered, but just from a holistic perspective, we have seen substantial pullback in the OPEX ratios as well as improvement in the loss ratios, despite the growth which we have witnessed this quarter. Just wanted to ask you in terms of sustainability of these numbers going forward.
Yes, see, these are choices that we have made, and I see no reason why there should be any change from in the direction as well as what we have put through in Q3.
Got it. And sir, with this EOM new guideline, pricing as an important lever will no longer be a major way to grow. In your view, what will be the other aspects for let's say, Chola to outperform the industry growth?
Definitely, there is a potential for growth is very much there, given the thrust as to penetration and general economic growth which will be there. We will also see Chola MS strength is also over what it has been doing in the Tier 3 and market. So we will have to penetrate the market. Quite naturally, we also have the prospect of about another 5-6 players entering the scene. And from a competition intensity, we have discussed this a few times even in this call, it's only going to be on the rise. And it will all start in the metros and urban markets. So the key, as I would see, is also in building a presence and strength in the Tier 3 and such markets for sustainability.
Got it, sir. This is really helpful. Thanks and all the best.
Thank you. I would now like to hand the conference over to management for closing comments. Over to you, sir.
Yeah, no, thank you. I think I just like to summarize a few points. Is that one has done a good performance. Insurance has done a growth, which is back to about 25+%. Aggressive, higher than the market growth. Investment portfolio reaching about close to 14,500 probably at the year end. We will have a portfolio mix work done on the investment side as well. Product choices, region choices, very careful work is being done. At this point in time, the leadership at all levels is fully available, and they have got fully revamped team in place. Investment as far as the IT infrastructure as well as applications, a key project is undertaken, and I think it will take about a couple of years for us to change the course in a far better way than what we are currently having it. All this will augur well for this insurance business. And with that, I think thank you all for participating in the call. All the very best. Thank you.
Thank you. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
The conference is no longer being recorded.